Al, as we get into this final segment here, these shows go by so fast, and I feel like we don't get enough time to talk about things. And so we got to go quick here. I want to talk about this thing you were mentioning earlier about reading what the institutions are doing. And it's based off, it's not in a book, right? It's based off a price chart because that's actually telling you what that is. Now, to kind of give an example of that, think of, I mean, winter is almost over. It sounds like we might be getting a little bit of snow here on Monday. Right. And what if it snows an inch and you walk down the road before it gets plowed? You leave behind you a footprint in the snow, right? When institutions are moving large amounts of capital, they are leaving footprints on a price chart. And that's where, when Al is talking about identifying where they could be buying, where they could be selling, that's where you identify that. Elaborate on that a little bit more, Al, but sprinkle in a little bit of those futures and Forex markets, how someone might use a price chart to make decisions with those leveraged assets.
Sprinkle?
Okay. I'm thinking of donuts, okay?
Okay.
I'm going to Hy-Vee and getting some donuts today, okay?
Yeah. Oh, okay. Well, yeah. There's several assets that you can use in addition to stock and mutual funds. And most of us are just conditioned to look at stocks and mutual funds as the way to be in these markets. There are assets like the futures market, the foreign exchange market, in addition to options that give you leverage. And that leverage is really just taking the dollars that you have and maximizing the value of them, maximizing the potential of them. The institutions do this on a regular basis. You know, their bottom line is really based not just on fees that they get from their clients. You know, some of them do IPOs or bring companies public, maybe some mergers, acquisitions. But for a lot of these firms, their profit, the biggest profit, comes from their trading their own accounts and basically trading your money for them. And they're using things other than a long-term portfolio. The traders for Goldman Sachs or JP Morgan do not just take all their money that they're allowed to use by their firms, and maybe tens of millions of dollars. They don't just put together one portfolio and then hold on to it for 20 or 30 years. They're trading those on a daily basis. And those are short-term vehicles then. So if you're looking for addressing short-term financial needs, then you need something other than a long-term portfolio. It could be futures. That's where you're looking at, you can trade the major stock markets. You can trade commodities. You can trade currencies, interest rates, oil, gold, silver, a number of different things that give you the opportunity to be truly diversified. And I know Josh will not be happy unless I let him tell you what his favorite commodity is.
That will be lean hogs.
Lean hogs.
We have to do it every Saturday.
Why? I don't know. And I'm not even sure if I want to know, but it is just one choice. You can do sugar, corn, soybeans. There's a number of things there that really give you the opportunity to be truly diversified. Some of those things within the futures world can be utilized as a way where they correlate with each other, and they could be an inverse correlation. No correlation at all.
What does that mean, inverse correlation?
Well, it means that one asset will go up in value while another one goes down.
So you can potentially protect yourself that way or hedge yourself.
You can hedge yourself. You can actually be in a position where you'll benefit if something goes up. You can be in a position at the same time where you're benefiting if something goes down.
Okay.
And then there's some things that are not correlated at all. Sugar in the S&P 500, for example. There are some things that are correlated. So you might look at investing, say, in the
there's
the S&P 500.
Yeah, S&P 500. There's some currency pairs that actually mimic the S&P 500.
Exactly. So you can use one part of the futures world to get a better idea of whether you're going to be right in your decision with another asset.
And more odds enhancers too.
And more odds enhancers. And in the futures market is open almost 24 hours a day, so you have many more opportunities to participate. It allows you to do a better job of managing your assets, and it has a tax advantage, even though you are short-term trading. And for people that want to do this, very short-term, you don't fall within that day trader status, which you do with stock. So you eliminate that, and you have a tax break there, a 60-40 split, 60% treated as long-term capital gains, 40% as short-term, even though your trades are short-term. That's a big advantage to a lot of people. Then you've got the Forex market. That's the market where you're looking at the difference in exchange rates between two different currencies is traded as a pair, again, open 24 hours. Both futures and forex have great leverage, maybe anywhere from 20 to 100 to 1 leverage.
Yeah, and that's a great thing about these other assets is you can still potentially trade like the stock market with other assets like the currency markets, or there's some commodities that will mimic the markets as well. But you got to learn how to do that. And think about this too: if you work during the day, you have the opportunity to trade and invest in the evening with them being open
Right.
around the clock. That gives more people more options. No pun intended, right?